So there's nothing wrong with gold right now. And the fact that it's done so well this year in advance of the kinds of things that I would have said, or that I did say would take it higher, like the recession or the rate cuts. We haven't had the rate cuts yet, but those are typically good for gold. And those are ahead of us from, plus or minus 2,300 base. I think that's fantastically bullish for gold. And most important, is that we've seen in this latest breakout, we've seen the equities finally starting to show that leverage to the underlying metal that's our whole reason for buying them, right? If the stocks aren't going to, they can't just move up. Gold stocks can't just move up with gold. If that's all they did, there'd be no point in buying them. It's much safer to just buy the metal. It can't go bankrupt.
Gold prices traded at $2,336.02 per troy ounce, marking an increase of 0.78% from yesterday and a significant 13.05% rise since the beginning of the year. This robust performance has caught the attention of analysts and investors alike. Lobo Tiggre, editor of the Independent Speculator, noted that gold's performance this year is particularly remarkable. It has surged even before typical catalysts such as recessions or interest rate cuts, which are usually bullish for gold, have occurred. This suggests a strong bullish outlook for gold moving forward. In March and April 2024, gold prices hit multiple new highs, defying expectations given the robust economic data and delayed market expectations for the next rate cut in the U.S. Typically, such conditions would be negative for gold prices. Many analysts in the gold community appear puzzled by this sudden increase and question its sustainability. Investor sentiment towards gold has also improved. Net speculative positioning in gold futures has increased over the past few months, from the somewhat depressed levels seen in October 2023. However, the current positioning aligns with the 5-year average, indicating it is well stocked. Tiggre also highlighted that gold equities are beginning to show leverage to the underlying metal, which is a key reason for investing in them. With this leverage, investing in gold stocks would be more appealing than holding the metal itself, which does not carry risks like bankruptcy, nationalization, or operational setbacks. Despite the favorable conditions for gold, Barrick Gold stock has declined by about 11% year-to-date. This underperformance is notable given that gold prices have been trending higher, rising from around $2,050 per ounce in early January to over $2,300 per ounce. The increase in gold prices has been driven by cooling inflation, expectations of interest rate cuts by the Federal Reserve, and geopolitical uncertainties following the Israel-Gaza conflict. Join us as we delve into Lobo Tigre's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
What are we going to do with gold? It's only $2,300. I mean, really? That's the complaint? It's only $2,300? Okay, but it should be 5,000. Yeah, but no, I hear you. But this is serious. We're joking, but it's serious. Like, this is a terrific price. Excuse me, gold dollar exchange rate. The better companies are gushing cash at these levels. The mediocre companies are making good money at these levels. The crappy ones are still crappy, and that's great because now you can see who's crappy and who's not. So there's nothing wrong with gold right now. And the fact that it's done so well this year in advance of the kinds of things that I would have said, or that I did say would take it higher, like the recession or the rate cuts. We haven't had the rate cuts yet, but those are typically good for gold, and those are ahead of us from, plus or minus 2,300 base. I think that's fantastically bullish for gold. And most important is that we've seen in this latest breakout, we've seen the equities finally starting to show that leverage to the underlying metal that's our whole reason for buying them, right? If the stocks aren't going to, they can't just move up. Gold stocks can't just move up with gold. If that's all they did, there'd be no point in buying them. It's much safer to just buy the metal. It can't go bankrupt. Right? It can't be nationalized. You can't discover the legendary, endangered mosquito on your key property, right? The metal doesn't have any of those problems. So if you're not going to get leverage to the metal with the stock, there's no reason for owning them. And we haven't been seeing that leverage for last years. I'm glad you like my mosquito joke. But that leverage has come back in this latest breakout. So I think, without taking over the whole show, there's a free report on my website called Are Gold Stocks Broken? It's not really a report, it's an article. And at the time I wrote it, my assertion is they're not broken. You'll see. Now we already have that evidence. Like they're back. The mojo is back. They're doing what they're supposed to be doing. And if I'm right about where gold goes this year, if we go blow past 2,500, and I don't want to give you a number, David, because it gets a bit too Jim Cramerish if I do that. But if gold goes where I think it's going, and the mojo is back in the gold stocks, this is fantastic news because many of them are still on sale. If I believe there's an opportunity here, and it is my highest priority right now with my own hard-earned cash to load up on more gold stocks ahead of this. But the worst of the inflationary blowouts was in prior years. So we're seeing it already, and we are actually getting data. I think you've seen this in Q1. All of the big gold producers beat. Now that doesn't mean they all did, great. It means they beat expectations, which is good. And for the, I don't like to tout any one company, and I'm not recommending this company. I don't own it, but the largest gold producer in the world is Newmont. And so when Newmont beat on its guidance as the largest gold company in the world, that was headline news. It was big enough to get covered on CNBC and Yahoo Finance and Bloomberg and those sorts of places that usually don't talk about gold mining stocks. But this is important for a couple of reasons. One, it's the answer to your question, is that we're seeing the companies actually have some discipline here. And remember that they actually have a business. They're supposed to be making money mining, right? And they're working on that. So it's good to see the big producers beat. The other thing, though, is part of the thesis is you eventually in these markets, you're expecting a mania phase in the final stages of the blow-off peak, right? For that to happen, you need to have media attention. So for the media to pay attention to Newmont quarterly earnings, like when was the last time you heard mainstream media talk about Newmont's quarterly earnings? Basically, I don't remember it ever happening.
The Federal Reserve announced on Wednesday that it would keep interest rates unchanged at their current levels and projected only one rate cut for the year. This decision marks a significant shift from the central bank's earlier forecast in December, when it anticipated 3 rate cuts for 2024. Central bank officials cited stubborn inflation as the primary reason for scaling back rate cut expectations. In their new economic forecast, they noted that while inflation is expected to tick up later in the year, achieving further reductions towards the 2% target will be challenging. This adjustment comes as high inflation figures from the previous year create a base effect, making it difficult for inflation to appear substantially higher this year in comparison. Lobo Tiggre, a prominent voice in the financial community, emphasized that the lingering impact of last year's high inflation rates is providing a tailwind that will diminish over time. As this base effect wanes, Tiggre believes that achieving significant reductions in inflation becomes more daunting. Let's get back to the interview.
Inflation comes in substantially cooler than you're thinking, or it's reported anyway, to be substantially cooler than expected. And you've got a model and you know what the numbers mean to you. You probably have it on a spreadsheet somewhere where you plug the new CPI number in and it gives you a new output, which, each one of these guys and gals has their model. So to think that they didn't have time to adjust their dots because it came out the same morning, that just doesn't pass the smell test with me. The FOMC meeting and Powell's press conference, is that like live? I don't know what the frequency of updating is. Like, I would not be surprised if that was the case this morning, but for it to still be, putting in a better than 50% chance after the FOMC statement
it's pretty live because I'm updating it right now as we're speaking right now, and now it's at 56.
Well, Mr. Market is pretty optimistic. Let me throw something else in there I didn't mention in the overview of Powell's remarks and the FOMC statement. They did increase their PCE expectation for inflation to 2.8% by the end of this year from 2.6 before. We're already under that amount, actually. So that actually is a bearish outlook from the FOMC itself. It suggests, stickier inflation than the optimists here looking for a September rate cut seem to be penciling. And remember, today's wonderful numbers, cooler than expected across the board. That was CPI, not PCE, that the Fed says is more important and that they're basing their goals on. So the same day, the Fed comes out and increases their target, their inflation expectation on their preferred measure. And to me, that doesn't square with his optimism on the CME rate forecast. Okay. I'm a due diligence guy, right?
Yeah.
I spent 15 years kicking rocks for Doug Casey, looking at mines, and that's really my specialty. I'm not an economist, though I just play one on TV sometimes. So let me before I answer, let me also remind you that we're getting to the point where base effects. Remember, we had these huge ramp ups to 9% inflation or 7% on PCE, whatever. you had this huge ramp up, and then you have the cooling numbers. It was hard to have higher inflation prints compared to those higher numbers before. So there's this giant tailwind for this year's year-over-year numbers based on the higher numbers from before. That's going away. In fact, we're getting to the very end of that tailwind right now. In the month ahead and going forward, that tailwind from base effects goes away or goes into reverse. So I think it's quite reasonable, without making any, table pounding, clickbait headline predictions for you. I think it's very reasonable to say that the progress from here to the magical, mythical nirvana of 2% is going to be much more difficult. The base effects alone say that. And then you've got things like the OPEC Plus extending their production cuts. You've got commodities, to the degree that, I'm wrong about the recession and Dr. Copper is signaling a strong economy. You've got commodities prices up. There are a lot of reasons to think that inflation, if at the very least, will be sticky above the Fed's goal. And there's a good chance that with base effects, it'll actually start going up again over the course of this year. I don't have a goal. I don't have a number for that. I'll be pleased if I get the direction right. But we may actually be seeing a bottoming in inflation, as reported by the government at any rate, right now.
As we reflect on these dynamics, the overarching question emerges. How sustainable is gold's current surge amidst diverging market expectations and Federal Reserve policy shifts? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.